Next up on the line, we have Mike Moore from Veritas Asset Management. Mike, just to check that you are coming through loud and clear.
Yes, I am. Can you hear me?
Yes, I can. Perfectly. Thank you very much. And it's not Mike Moore, the famous bearded American documentary maker, but instead Mike Moore, the portfolio manager and analyst at Veritas Asset Management. Veritas invests in high quality companies, as many of you are aware, and we've been partnering with them now for, I think, over 10 years, almost about 12 years. I think in 2010 we started that partnership. So Mike's presentation today is titled Investing in an Environment of Less Transitory Inflation and Normalising Equity Valuations. And that last point about normalising equity valuations is something that I'm going to be very interested and focused on this morning. So Mike, I'm going to hand over to you for about 15 minutes or so, and then we'll catch up for a quick couple of questions at the end. Thank you very much.
Okay, great. Thank you. Just go on to here. So in terms of the presentation that I wanted to conduct today, it was really looking at the kind of the issues that central bankers and sort of policymakers face with rising inflation that we're seeing at the moment, and also having to contend with that in terms of some of the kind of the implications of the policy that they make over the medium term. So in terms of the kind of the presentation side, I think the central bankers are more in sort of a catch-22 situation and at present. In terms of what I'd like to go through to start with is obviously the performance of the fund over the last 3 months. And in terms of the fund, it's declined by 12.9% over 3 months, and 16.2% versus 16.2% for the MSCI World. So around about 320 basis points of outperformance. Over 12 months, we've seen sort of minus 13.9% decline versus the MSCI World at 14.3%. So again, outperformance versus the index there. The one thing that I would say is that obviously the second half of last year, we saw significant increases in equity markets, and then kind of a precipitous drop in the first half of this year. So that kind of explains the 12 months. We lag on a 3 and a 5 year basis at present, and since inception we've delivered 7.95% returns versus the MSCI World at 8.84%. The one thing I would say is in terms of the return profile, it is as we would expect in terms of shape. We typically do better in low return environments or declining market environments, and that's because we invest in durable cash flow generative businesses that typically have sort of defensive characteristics. At the same time, we continue to focus on sort of valuation discipline, and obviously in the last couple of years valuations have become extremely extended, and some of the sort of better performing stocks in that period have had sort of have been very highly valued, which again is starting to unwind to a degree. So we think that will be an opportunity for us sort of going forward, and we are seeing sort of incremental opportunities start to flag as markets decline. In terms of the sort of the attributes from a sector and regional basis, the industrials sector gave us sort of 1.4% sort of relative performance in the last 3 months. That was largely driven by BAE, which is a UK defence stock, and that has come about from a re-rating driven by the kind of the geopolitical tensions that we've been seeing sort of more broadly in the global arena. Technology was also a 1.5% contributor. That's actually because we have sort of technically an underweight in technology, but that's not anything in terms of sort of intentional. That's actually due to sort of high valuations in the sector precluding us from deploying capital there. So that's something that has benefited us. We have had a 1 point sort of drag, and that's been from sort of energy, utility, and financials. And typically, we won't invest in these areas primarily because of kind of the industry structures. So, for example, in financials, spread financials particularly, we find that the barriers to entry are very low. And then in terms of the energy and in terms of the energy sector, through cycle return on invested capital is actually very low, and there are concerns on sort of the capital allocation there. So that's something that we have done historically and we continue to do. In terms of the geographical performance, UK was 1.7% contributor, but that again comes from kind of BAE, and North America was about a 0.5% contributor as well. In terms of cash, the level at the moment is 11.5%, and that basically gives us a lot of optionality to deploy capital when we have the right levels of IRR that we can deploy using kind of an absolute valuation mindset. And so that's something that we that we will look to deploy as valuations sort of moderate going forward. That has had a sort of relative positive impact, but we do that because we're looking at deploying capital on an absolute basis when the IRRs flag up to us. If we go now to the kind of the individual holdings, BAE is the largest holding in the group now. That's actually been driven by the outperformance of the company, but Alphabet and Charter were the two biggest positions prior to that, and are now at number 2 and number 3. And Canadian Pacific, which again has been a strong performer, sort of rounding out sort of the top 4. In terms of the sector weightings, healthcare is 30%, which is effectively sort of pretty similar to what it's been historically. And we do have 25.3%, 25.6% in communication services and information technology. And so in terms of communication services, that contains things like Alphabet, Meta, and Charter. And so that is broadly kind of the kind of TMT exposure within the fund. That has reduced slightly from sort of 27-28%, and that's been driven by the kind of the valuations of the technology sector falling over the period. In terms of the cash, again, that is 11.5%, and that gives us an opportunity to deploy. And in terms of the regional weightings, we have around about 65% in North America. That's come down from about 67%. And that's been largely driven just by sort of changes in valuations and kind of the mix, rather than anything that is more, taking a view on any individual geography. So in terms of the kind of the presentation, I just wanted to sort of go through what the current sort of implications for what I'd describe as sort of a catch-22 for central bankers and policymakers in terms of having to address high levels of inflation while also managing not to sort of impair the kind of the real sort of the real economy. And obviously sort of valuation normalisation of some of those factors also coming into play. So the first thing I'd say is, we've had a significant liquidity injection and sort of supply side shocks from geopolitics, and that has led to unintended consequences. And so the chart on the left here shows kind of an 8 trillion expansion in the Fed balance sheet over since the financial crash in 2008. Half of that has come in the last sort of couple of years. There's also been a commensurate sort of fiscal stimulus as well. And I think it's useful just to sort of frame what, how quickly things have changed and, this point about inputs and outputs. So in February 2021, Joe Biden said, the biggest risk is not going too big. If we go, it's if we go too small. A month later, Janet Yellen said, is there a risk of inflation? I think there's a small risk, and I think it's manageable. Roll forward sort of 4 months, and then you've got Biden saying, well, there's potentially signs of persistent inflation, but from what their experts believe, and the data shows that most of the price increases we've seen were expected to be temporary. Now, there was a real change towards the back half of the year. So November, Jerome Powell said, it's probably a good time to retire that word transitory and try to explain more clearly what we mean. And then only a month later saying the real risk now is that it is more persistent. If we then forward now to sort of May this year, inflation is much too high. So in only 15 months, you've seen a real switch between, it not being a, there not being a particular problem to their one being, an actual, pretty significant problem now. And so in June, you saw the Fed funds rate being raised by 75 basis points, which hasn't happened since 1994 was the last time you got a raise that size. I think one thing to note here as well is just that it's extremely difficult for policymakers who have, an asymmetric information advantage to actually see what the inputs and outputs are of their strategy. So from an equity investor point of view, it's very difficult to actually be able to, consistently get that right from a macro perspective, and then actually working out what the market's going to do in relation to that is also a second degree of freedom, which is also makes it more difficult. So we actually think what you really need to do is focus on, high quality companies who, irrespective of what the macro throws at them, can actually handle these situations the best and have the most amount of self-determination. And we think that is actually a much more durable and consistent way to actually invest when you've got high degrees of uncertainty. In terms of that inflation, the kind of the inflationary pressures continue to persist. The implication is higher rates and tapering needed. If you look here, so you're looking at sort of peak inflation at 8%, it's now 9%, a level not seen since the early 80s. I mean, the one thing that I would say here is obviously some of these things are one-off factors that will dissipate away. So maybe some of the energy costs will come away, but overall, had a period where 2 to 3% inflation has been the norm. And now we could have a period where actually that inflation rate is actually, a couple of percentage points higher as it normalizes. We don't know, but it could be more persistent, and that's what central bankers are worried about. If we look on the right-hand side, which is kind of wage indicators, you can see that actually the wage growth is around 6%. So importantly, it's lagging inflation, so people are getting poorer in real terms. And 50% of small and medium-sized businesses are saying, small business owners are saying that they have positions open. So the issue is some of these sort of wage factors and this inflation is actually being potentially more persistent because of the more persistent. Sorry about that. Because of the it's going to be more persistent because it gets embedded in wage expectations. And so that is something that we think is going to be a challenge going forwards for policymakers, and it's something that we still think is something that needs to be watched in terms of how that's managed. At the same time, consumer confidence and sentiment are eroding. So if you look at the sentiment, the consumer sentiment, which is the red chart here, this is actually at levels that we haven't seen in sort of 55 years. So the kind of lowest levels on record. And you have to remember as well that 60% of sort of US US households live paycheck to paycheck. And so this does have an impact on the kind of the real world economy. And like I say, the one thing that's really important here is the delta between peak sentiment and trough sentiment. It's actually at levels that we haven't seen since 01, 02 or 08, 09. And in those periods, we saw much more precipitous sort of drops in equity markets. So recession concerns are, real and valid. And we do think, that at present it is still, the actual declines that we've seen so far in the market don't necessarily factor in some of the headwinds that the policymakers are facing and the real economy is facing. So that's why I say it's a bit of a catch-22 situation, because the policymakers have to rein in inflation, but at the same time they have to protect the real economy as best they can, and those two things are not potentially those two things are potentially sort of things that are sort of acting against each other. So in terms of the equity markets, valuations became significantly stretched sort of last year and have started to normalise as rates have risen. So if we look at the 10-year monthly government bond yields, those fell to sort of all-time lows, sort of around sort of the kind of end of sort of 2020, 2021. And obviously what that did was that depressed yields on other assets and sort of inflated their valuations. It also had the impact of reducing the discount rate, which meant that free cash flows further out in the future were more attractive. And that also led to sort of a chase for sort of more speculative assets as well. And so if you look at the bottom left chart, which is the MSCI World Software and Services sort of valuation and index, that saw a significant expansion in terms of the index, which is now sort of down 30% from peak as those government bond yields have risen, and obviously some of those long duration free cash flows become less attractive. And so what we've seen at the same time is I think the Goldman Sachs non-profitable technology index has fallen sort of nearly 60% from peak to trough, as all this has started to normalise. At the same time, the S&P cyclically adjusted sort of PE was at highs that haven't been seen since the kind of dot-com bubble in 2000. And that has actually, again, retrenched as we've seen some yields and interest rates rise and anticipate sort of further rises in the future. But they're still at a relatively high level versus history. The other factor to consider, which I think, and this was slightly maybe surprising to people, is that whilst there has been a derating, actually earnings estimates still haven't really sort of reflected that at an aggregate level. And so, as I've sort of said earlier, the kind of demand environment is actually pretty choppy for companies, but corporate profitability has got a number of pressures. And so at the moment, the operating margins, I think, of the S&P are around 13.3% in terms of the operating margin. And what you've got is the kind of the wage inflation that we were talking about there. You've got input cost increases that are going through as well. And I think when you take these all into consideration, what you find is actually there's a lot of pressures on corporate profitability. If you go down below the operating income line as well, you've got interest rate rises will also have an impact as well going forward. And really, when you look at it, you see that the S&P line here has gone from sort of 22 times forward PE to sort of 17 times. Now, part of that is obviously the kind of interest rate normalization, but also there is the issue around kind of EPS and whether that kind of the earnings number is right at an aggregate level. And so if you look at the S&P, it hasn't really moved. Now, you could argue, well, that's, maybe some of things like energy are kind of sort of holding it up. But if you look at the technology earnings, they are also pretty static. And so we haven't seen the kind of the pressures come through yet. And we do think that is beginning to happen. And that although the market is anticipating, with the decline in sort of forward valuations, it's not adequately anticipating interest rate rises and also the kind of the earnings pressure that potentially the market could see from a more challenging economic environment. And so we're still very much cautious as going into sort of the back half of 2022 and into 2023. In terms of concluding remarks, I say, how do you invest in an environment that is, it's clear kind of policymakers' inputs and outputs are very, it's very unclear how that will actually feed through. You've got obviously cost of living squeezes, you've got sentiment at lows. How do you invest in that? We think you definitely want to be focusing on companies with durable competitive advantages, ones that have got pricing power, because if inflation, when it normalizes, is higher, then it's the ability to pass that price on. You do want the rising tide of long-term growth markets because, again, that offsets some of these inflationary pressures. You also want to have companies that have high return on invested capital, free cash flow generation, and that ability to compound, which is a real key driver to economic value at the company level. And importantly, you want companies that it doesn't cost a lot to grow, because as inflation, if it is more persistent, then actually the cost of growth is more. So asset-light businesses are also sort of preferred. In terms of deploying that, we think you have to retain sort of the value discipline and an absolute mindset in terms of the valuation approach because of the rising interest rates, which is how we deploy capital. And then finally, you have to be patient and wait for the opportunities. And so what you're seeing at the moment is opportunities are beginning to sort of emerge as obviously there is a sort of a broader shakeout in terms of the demand that companies are seeing. But it's to really focus on those opportunities. In terms of the portfolio, at the aggregate level, we have around about a 23.6% operating margin, which is sort of 10 points higher than, say, for example, the S&P average. We have a ROIC of 14.9%, but that's actually in the low 20s if you exclude goodwill, which is kind of acquisitions. And then in terms of the free cash flow, we have a free cash flow yield of 4.6%. Rising to 8.8%, so demonstrating that free cash flow growth over the next 5 years, and a net debt to EBITDA of around 1.6 times. And so, in summation, we think you want to be focused on competitively advantaged companies with a high degree of self-determination, and that's really where you want to be because of the many, I guess, sort of unclear sort of macro factors that are going on. But you also want to be able to do that with, a clear valuation discipline, and that we do think we will get opportunities to deploy capital, and that's what we'll look to do going forward. And with that, let's say thank you and any questions.
Fantastic. Thank you very much, Mark. Firstly, good recovery on the slide hiccup in the beginning there. You had my heart in my throat. I wasn't sure if you were going to be able to share or not. Unfortunately, we have run out a bit of time, but thank you for mentioning, and I should have probably said this in the beginning, was your focus on quality companies, but also producing absolute and real returns for clients through the cycle. And that came through quite strongly when you referred to energy companies and you're holding there. And that's maybe something we can explore in the next fund manager workshop. But we are out of time for today. So thank you very much for joining us, and we will catch up with you next quarter.
Great. Thank you.